find the work that they want and need. And of course, the income distribution problem. But that's also associated with that. If we get, when we get back up to full employment, like when we had 3.8% unemployment in the second half for, parts of the second half of the 90s, we had rising wages, and the bottom 20%, their income was growing just like everyone else, for that brief period. But unfortunately, that hasn't been the case for most of the last 30 years, when as most of you probably know, over 60% of the income growth in the United States went to the top 1% of the income distribution. So those are our problems. Problem of employment, problem of distribution. Neither one of those is a problem that's going to be worsened by the federal government actually at this point, when the economy is weak, borrowing and spending more money. Now, if that makes too much sense for you, and you're wondering why they don't do that, I guess we can talk about that in the question and answer. In the ECB case, it's a little more obvious. So let me switch to Europe for a little bit, because that's where the cartoon comes from. And in the case of Europe, you have the Eurozone economies, the 17 economies, and they have one common currency and one central bank. And they're doing a lot worse than we are. They're in recession again. So it's their second recession in 3 years. I would say self-inflicted. So it's a lot of misery for nothing. And they have similar level, Europe-wide, you have about the same amount of people in all of Europe. For example, you have 25 million people, like in the United States, who are unemployed, underemployed, or given up looking for work. And it's much worse now in the Eurozone itself. In fact, if you look at the latest numbers from Europe, you had the latest month, I think it was February, you had 167,000 more people unemployed, and 162 of those came from the 17 Euro countries, not the 27, the whole 27 members of the European Union. So it is a policy of the Troika, of the European Central Bank, that is preventing them from doing what they should do. And last year, that crisis got so bad that it really weakened the whole world economy. You might have noticed that. I guess you would notice it more if you were in Brazil, for example, where they grew at 7.5% in 2010 and only 2.7% last year. A lot of that was due to the shock that they got from the crisis in Europe. It reverberated all over the world economy. And if you look at the projections for world economic growth, those dropped by 1.2%. Now you think, well, that's not very much money. But in terms of growth of the world economy, that's over $700 billion. And it affects people all over the world, in Latin America, in Africa, even in Asia, which is relatively fast growing. They're all affected by just that stupidity of the European Central Bank that actually forced an economic crisis where you didn't need to have one. Now, why didn't you need to have one? If you followed that crisis at all, if you didn't, it's okay. I'll explain it to you a little bit. There were two main problems that Europe had to deal with last year. One was the Greek debt, which we'll get into in a minute. And they didn't want to, they kept squeezing Greece. They didn't want to even recognize that you had to have some debt cancellation there, which was, of course, ridiculous. As you can see, they ended up canceling more than half of it. But for all of 2010 and most of 2011, the European Central Bank and the European authorities were still pretending that we're going to squeeze every last dime out of this country, even if we have to have, 50% unemployment or whatever you would have to do. And of course they couldn't do that, and so they had to adjust that. But the other problem they had, which caused a bigger crisis and really caused the whole world economy to stutter, was that you had these interest rates rising on the big countries, Italy, Spain. Okay, their debt is much bigger. It's many times bigger than Greece. And their debt, the interest rates on those bonds went up. And it went up over 7% in Italy last year. And once it reaches a certain point, you know, and remember, every country has to keep rolling over. They have debt coming due. And if it gets too high, then it becomes unpayable. And that was what really jolted the world economy, because those two countries are too big to fail. As you can see, Greece can default on half of its debt in a restructuring, and it can even default on all of it, and they can absorb that. Greece is only not even 3% of the European Union GDP. And Portugal and Ireland, which are already under IMF agreements, they can also default on their debt, and that can be handled. Spain and Italy are too big. And so the European Central Bank was basically playing chicken with those two debts. Okay? They were watching as the markets continued to bid up those interest rates. In other words, they were dumping Italian and Spanish bonds. And the European Central Bank, of course, can do what the Fed did here. They can come in and buy those bonds and push the interest rate back down. And they did that, you know, in August, and they did it a couple of other times, but very temporarily and without any commitment to the future, so as to maintain this crisis. Now, why did they do that? I talked about this a little bit the last time I was here, but the simple story is, to make it short, is they didn't want to get rid of the crisis. They could get rid of, and you're having a bit of a crisis even this week, because the Spanish bonds went up over 6%, and you saw it even affected the stock market here in the United States. That's the one thing everybody gets to see on TV, right? They're always showing the stock market, even though most of us have no significant interest in it. Most of us in the United States don't even have significant stock holdings in our retirement accounts. But they do show that, and you can see that it affected even that. Now, why are they doing this? Why have they done it? They've done it because they want to change these countries. They want Italy and Spain to have lower retirement ages, which they're doing, okay? They want, you know, in Greece they lowered the minimum wage by 20%. In this last package for the debt restructuring, and they agreed to lower it for younger people by 32%, 18 to 25. And, you know, that's not a lot of money already they're living on. And they, you know, they raised the retirement age. You know, there are hospitals that don't have medicine. Let me just, you know, read you a little so you realize that this all isn't just a bunch of numbers. And this is from the British medical journal, The Lancet, talking about Greece. Suicides rose by 17% in 2009 from 2007. And unofficial 2010 data quoted in the Parliament mentioned a 25% rise compared with 2009. The Minister of Health reported a 40% rise in the first half of 2011. Again, suicide rates compared with 2010. Violence has also risen. Homicide and theft rates nearly doubled between 2007 and 2009. Of course, it's all much worse. It's now more than 2 years later. And there was a 52% increase in HIV incidents from 2010 to 2011. The hospitals, you know, read stories in the press, they don't have medicine. This is what they're doing to Greece. They believe, the European authorities and the IMF believe that Greece needs this. They believe that Italy needs more of this. They believe Spain needs more of this. They think that this is an opportunity. This crisis, this is not a conspiracy theory here, okay? This is what they say if you read the fine print in the article. You know, you read down to all the end of the articles in the New York Times. You can see them saying that they do not want to